Hey, welcome to our deep dive into the world of the stock market. This dynamic entity, frequently under the spotlight in the news, is a vital cog in the economic machinery, not only at a national level, but also on a global scale. Have you ever pondered about its significance, its purpose, and how it works? You've arrived at the right place for your quest. The stock market, to put it simply, is a virtual platform where eager buyers and sellers participate in the exchange of shares. These shares are not just ordinary assets. They represent fractional ownership in a specific company. However, the stock market is more than just a marketplace. Rather, it serves as the beating heart for the global economy, propelling growth and development. To provide a concrete example, just imagine owning a minute fraction of a tech behemoth like Apple, Google, or Amazon. This is feasible through the purchase of their shares or stocks. As a proud shareholder, you acquire a small piece of the giant corporate pie, granting you eligibility to a slice of its profits and even giving you some influence over its future course. But what is the rationale behind the existence of the stock market? The purpose of the stock market is to create a win-win situation for both corporations seeking capital and investors looking for profitable avenues. Companies list their shares on the stock market in a bid to raise capital. This capital is the lifeblood of a business, used to fund expansion, nurture research and development projects, or even to pay off debts. On the flip side, investors purchase these shares with the optimistic hope that the company will prosper and their investment will subsequently multiply in value. The stock market also serves as the economy's barometer. A bullish market often signifies that companies are flourishing and the economy is in a robust state. Conversely, a bearish market may indicate an economic slowdown, recession, or a potential financial crisis. The journey of learning about the stock market isn't merely about the euphoric highs, though. It's crucial to that investing in the stock market also carries a significant risk. Stocks can depreciate in value just as they can appreciate, meaning investors can face losses. This is why in-depth understanding of the stock market, its trends, and informed decision-making are vital components of successful investing. As we traverse through this enlightening course, we will uncover the fascinating history of the stock market, understand the fundamental principles of trading, and master the art of technical and fundamental analysis. We will also delve into the process of discerning promising stocks from the mediocre ones. Our exploration will also cover the role of regulatory bodies and comprehend how they help uphold the market's integrity and transparency. Whether you are a beginner venturing into the waters of the stock market or you're a seasoned investor with years of experience under your belt, the ever-changing stock market always offers something fresh and exciting to discover. We'll delve deep into the factors that influence market movements, the psychology of trading, and the strategies employed by successful investors to maximize their returns and mitigate risks. You'll be introduced to different types of investments, from blue-chip stocks that represent established and financially sound companies to penny stocks, high-risk stocks priced at less than $1. We will detail the pros and cons of each type of investment, helping you to make an informed choice. We will also explore a variety of investment strategies, from long-term investing that requires patience and resilience to day trading that demands quick decision-making skills. Our aim is to assist you in figuring out which investment strategy aligns best with your financial goals and risk tolerance. So, fasten your seatbelts. as we embark on this exhilarating journey, exploring the rich history of the stock market, the basics of trading, understanding technical and fundamental analysis, and mastering the art of picking profitable stocks. Whether you're a novice investor just starting your journey or a seasoned trader looking for more insights, there's always something new to learn in the dynamic world of the stock market. Have you ever wondered where and how the stock market originated? This compelling world of stocks, shares, and ceaseless trading possesses an absorbing history that spans over several centuries. It's a history that's populated with enthralling narratives and crucial occurrences. Today, we're going to delve deeply into the intricate details of this complex past, embarking on a captivating journey. This journey leads us back to the 1600s, navigating to the vibrant city of London, the cradle of what we now recognize as the modern stock market. London during the 17th century was a city of thriving commerce and bustling trade. In particular, coffee houses were not just simple establishments for enjoying an afternoon cup of joe. These were vigorous hubs of commercial activity, teeming with merchants, brokers, and aspiring investors. These individuals exchanged ideas, negotiated business deals, and essentially laid the foundation for the contemporary stock market. Jonathan's Coffee House is one such venue that deserves mention. It was a popular gathering point that gained notoriety for attracting a wide array of businessmen. This eventually evolved into the London Stock Exchange, signifying a pivotal turning point in the commercial world. For the first time in recorded history, individuals could buy and sell stakes in companies, giving birth to the idea of a functioning stock market. We then leap forward 100 years and across the Atlantic Ocean land in Philadelphia, the city of brotherly love. Here in 1790, the first American stock exchange was established. The Philadelphia Stock Exchange was instrumental in shaping the future of stock trading, and it served as the predecessor to the New York Stock Exchange, an exchange that is now the most impactful in the world. Established in 1817, the New York Stock Exchange, or NYSE, was born on Ordinary Street in Lower Manhattan, known as Wall Street. While this location may seem random to the uninitiated, it carries a deep connection to the city's past. Named after a wall constructed by Dutch settlers for protection, the area evolved into a vibrant commercial hub despite the wall's eventual disappearance. In the early days, the trading floor NYSE was a far cry from the technologically advanced operation we witness today. It was a chaotic scene, with brokers bellowing therein a practice known as open outcry. However, with the integration of technology in the late 1800s and early 1900s, the stock market began to modernize. The development of the telegraph and telephone made trading faster, while the ticker tape machine, invented by Thomas Edison in 1869, allowed real-time transmission of stock prices. This democratized access to the stock market, making to the general public. The stock market has also seen a great deal of turbulence. There have been numerous crashes, the most infamous being the Wall Street crash of 1929, which led to the Great Depression. This economic downturn lasted for a decade and affected countries worldwide. In 1934, to prevent similar crashes in the future, the Securities and Exchange Commission, SEC, was established. The SEC's main goal to protect investors, maintain fair markets, and facilitate capital formation. The latter part of the 20th century saw the stock market undergo a significant digital transformation. Electronic trading and online brokerages made stock trading accessible to the masses. Today, with just an internet, anyone can buy and sell shares from the comfort of their home. Despite its varied past, the stock market continues to play a crucial role in driving global economic growth. It provides the necessary capital for companies to innovate and expand. Furthermore, it offers individuals the opportunity to invest in these companies and possibly earn a substantial on their investment. So, the next time you're about to click buy or sell on your trading platform, spare a moment to appreciate the rich history market. From London's bustling coffee houses to today's digital trading platforms, the stock market's journey has been fascinating. It's been shaped by innovation, resilience, and the relentless pursuit of wealth. As we have seen, the stock market has a rich and varied history, setting the stage for the trading practices we see today. The past and present are intertwined, shaping the future. As we move forward into this thrilling and unpredictable future, we can only look forward with anticipation to the exciting developments that wait in the world of stock trading. Now that we know the history behind the stock market, how does one actually trade in it? Let's delve deeper into the all-encompassing world of stock trading. Beginning with the fundamentals. Imagine a bustling marketplace, teeming with energy, a hub of ceaseless activity. This is not your typical market where you haggle over fruit and vegetable prices. Here you're dealing in company shares. These shares signify a fractional ownership in a company. They represent a slice of the company's assets and earnings. When you purchase a stock, you're acquiring a piece of that company. Essentially, you're becoming a mini owner. It's an intriguing concept, isn't it? But the idea doesn't end there. Just like in a traditional marketplace, det må de gå I så pågi att dens baby's since shellcores send warp or is always changing, and the stock market is no different. The prices of stocks are in constant motion, swinging based on a variety of factors. As with supply and demand being the most critical, this dynamic nature might pique your curiosity, leading you to question, could I merely walk into this market and start buying stocks? The answer isn't straightforward. Here's where the concept of brokers comes in. A broker is an individual or entity that serves as an intermediary between buyers and sellers. In terms of the stock market, a broker is crucial for executing trades on your behalf. Brokers have the necessary access and a profound understanding of the rules. They navigate the market terrain very effectively. In return for their invaluable services, they charge a fee known as a brokerage fee. Brokers, like all other components of the marketplace, have evolved over time. Today, you have the option of choosing between traditional brokers who provide personalized advice and services, or online brokers who provide a platform for self-directed trading. Each type has its unique pros and cons. Traditional brokers can furnish you with valuable insights and guidance, but their services come with a heftier price tag. Conversely, online brokers are more affordable and give you the freedom to trade based on your judgment, but remember, you alone bear the responsibility for your decisions. With a broad understanding of the main players, we now venture into the diverse orders one can place in the stock market. The simplest of these is a market order, which allows you to buy or sell a stock at the best available price. However, due to the inherent volatility of the stock prices, can alter rapidly. Hence, limit orders are introduced to grant traders more control over the price at which they trade. A limit order lets you specify the highest price you're willing to pay when buying a stock or the lowest price you're willing to accept when selling one. Stop orders are another available choice for traders. They're designed to limit an investor's loss on a position in a security. With a stop order, Your trade will be executed once a specific price point has been reached. This can be particularly useful to protect profits or prevent further losses if the market moves against your expectations. Trading stocks is not solely about making a quick profit. It's about managing risk and ensuring that your investments are diversified. Diversification refers to the strategy of distributing your investments in such a way that your exposure to any single type of asset is limited. This approach aims to reduce the volatility of your portfolio over time. One of the most common methods to diversify your portfolio is by investing in different sectors or industries. If you were to invest only in technology stocks, you could face significant losses if that sector dive. But having diversified investments in healthcare, retail, and other sectors, your risk becomes more spread out. Risk management is another essential aspect of trading. It involves identifying, evaluating, and implementing measures to limit or control the risks associated with trading. This could involve setting stop-loss orders to protect your capital, only investing money that you can afford to lose, and regularly reviewing and adjusting your investment strategy based on market conditions and your financial goals. Trading in the stock market involves understanding the basics of buying and selling stocks, establishing collaboration with brokers, placing various types of orders, and managing your risk through diversification and other strategies. It's not just about picking the right stocks, but also about managing your investments wisely. The journey of trading involves a steep learning curve. Understanding these trading basics is the first step towards becoming a successful investor. And remember, every successful investor started somewhere. It's a journey of continuous learning and adapting. So keep exploring, keep learning, and keep growing. But how do we predict the future direction of a stock? This is where technical analysis and stock charting come in. You might wonder, what precisely do these terms mean? Allow me to enlighten you. Our discussion begins with the definition of technical analysis. This term represents a trading discipline utilized to assess investments and identify potential trading opportunities. Instead of evaluating a company's intrinsic value, the focus is on examining its price movement and the volume of shares traded. This approach is heavily reliant on the detailed analysis of statistical trends acquired from trading activities, which include price movement and volume. A scene where traders are gathered around a table, charts spread out before them, meticulously analyzing each line and number. This image can give you a glimpse of technical analysis in action. It's not a game of speculation or guesswork. It is grounded in patterns, trends, and substantial data. It's about separating the signal from the noise in the financial markets. Technical analysis is about discovering the underlying patterns in the seemingly chaotic movement of prices. Patience, discipline, and attention to detail are required. It is a skill developed over time through consistent practice and ample experience. A technical analyst's toolbox is brimming with an array of tools, charts, indicators, and patterns. Among these tools, the price chart holds a pivotal position. This graphical representation of price movement over specific periods is the canvas on which the technical analyst executes their work. Let's delve into the heart of technical analysis. The concepts of support and resistance. Imagine a support level as the floor and resistance as the ceiling in the world of stock prices. Visualize a bouncing ball. When it falls, it bounces off the dirt off the floor, representing the support level. Conversely, when it rises, it hits the ceiling, symbolic of the resistance level. When a stock price descends, it tends to bounce at a particular level known as the support level before starting to rise again. In contrast, when a stock price ascends, hits a specific point, the resistance level, before it starts to descend again. These levels play a crucial role for traders as they guide them in predicting a stock's future performance. If a stock can break through resistance, it's possible for the resistance level to transform into the new support level, and vice versa. This dynamic is the elegant dance of the stock market, a dance orchestrated by the rhythm of support, and resistance. Let's now shift our focus to trend lines. These might seem basic, but are potent tools in the arsenal of any technical analyst. They are lines drawn on a chart that connect a series of highs or lows. An upward trend line, for instance, connects the lows of an upward trend. It shows the level at which demand is robust enough to prevent the security's price from falling further. On the other hand, a downward trend line connects the highs of a downward trend. It signifies the point where supply is abundant enough to prevent the price from increasing further. Recognizing chart patterns is another essential aspect of technical analysis. These are formations within the price chart that, when pieced together, provide clues about future price movements. Each pattern narrates a story. For instance, a head and shoulders pattern often signals a potential trend reversal, while a cup and handle pattern may suggest a continuation of the trend. We'll now delve deeper into the art of reading a stock chart. A stock chart is a type of graph that displays the stock's price. Stock's price changes over a predetermined period. This visual tool assists traders in identifying patterns and trends in the stock's price. The x-axis on the chart typically represents time, and the y-axis symbolizes price. There are multiple types of stock charts, but the candlestick chart is the most commonly utilized. Each candlestick on this chart corresponds to a specific time period and displays the opening, closing, high, and low prices for that duration. The interpretation of each candlestick is an art form in itself. A green or white candlestick signifies that the closing price was higher than the opening price, indicating a rise in the stock price during that period. Conversely, a red or black candlestick suggests that the closing price was lower than the opening price, implying that the stock price dipped during that period. Reading a stock chart isn't just about scrutinizing the candlesticks, though. It's also about observing the volume bars, usually found at the bottom of the chart. Volume is a vital aspect of technical analysis because the number of shares traded during a specific period. High volume often suggests strong investor interest and can be a precursor to the start of a new trend. Mastering technical analysis can provide you with a considerable advantage in predicting future price movements. However, it's important to remember that technical analysis is just one tool in a trader's repertoire. It should be used in conjunction with other forms of analysis for optimal results, and it should be used in isolation. Mastering technical analysis can give you an edge in predicting future price movements. Technical analysis isn't the only tool at our disposal. Have you heard about fundamental analysis? This is a methodology that peels back the layers of a company's operations, offering an in-depth understanding of its true value. Its fundamentals, as they're often referred to. Let's take a moment to explore this concept. Consider it as a detective undertaking an investigation. The detective isn't just glancing at the surface evidence or the superficial tip of the iceberg. Instead, they're probing, digging beneath the surface, studying the company's financial statements meticulously, analyzing its standing within its respective industry, and scrutinizing the prevalent market conditions. It's about gaining an intimate comprehension of the business from its core. You're not merely gazing at the stock price. You're considering every relevant factor that influences it. This detailed exploration commences with a term known as earnings per share, albeit bij die share often abbreviated to EPS. This term references the fraction of a company's net profit designated to each available share of common stock. The calculation method is fairly straightforward. Simply divide the net income by the number of outstanding shares. A high EPS frequently signifies a profitable company, but like all things, caution is advisable. It's essential to remember, EPS isn't the only metric of success. Next in our journey, we encounter the price-to-earnings ratio, often referred to as the PE ratio. This valuation ratio is derived from dividing the market value per share by the earnings per share. This mathematical operation assists you in discerning what you're paying for each dollar of earnings. A high PE ratio might suggest that the market has high expectations for this company's future. But take heed, it might also mean that the stock is overvalued. Conversely, a low PE ratio could be a signal of a potentially undervalued stock, or conversely, it could signify that the company is encountering difficulties. After the PE ratio, let's turn our attention to dividend yield. This financial ratio reveals how much a company dispenses in dividends each year relative to its stock price. It's calculated by dividing the annual dividend payment by the market price per share. If you're an investor focused on cash returns, a higher dividend yield might appeal to you. But take heed. A high dividend yield might also suggest that the company has limited opportunities for growth. These metrics, while essential, only represent superficial layer of the iceberg. There are countless other factors to contemplate: the company's debt levels, its cash flow, its competitive standing in the industry, the competency of its management team, and a multitude of other considerations. It's also crucial not to overlook the broader economic context. What's the current state of the economy? Is it enjoying a period of boom, or is it in a slump? What about the industry? Is it on an upward trajectory, or is it on a decline? All these variables can significantly impact a company's future prospects. Therefore, you may ask, how does one assimilate all this information to select profitable stocks? The secret lies in unearthing stocks that are undervalued. These are stocks that are trading for less than their intrinsic value as determined by their fundamentals. Imagine this scenario. You're at a garage sale and you spot a pristine vintage comic book priced at a mere $5. Your knowledge informs you that this comic book is worth at least $50. That's an undervalued. Likewise, in the stock market, you're seeking companies whose stock price is lower than what the company's actually worth, according to its financials and its prospects. However, bear in mind, fundamental analysis isn't a mystical crystal ball. It can't predict the future. It's a tool, and like all tools, it's only as effective as the person wielding it. It necessitates time, effort, and significant financial acumen. You must be prepared to delve deep, to sift through the sea of numbers, to weigh the pros and cons. It can be convoluted, it can be overwhelming, but it can also be incredibly rewarding. Discovering that undervalued stock, spotting that hidden gem, offers an unparalleled sense of accomplishment. So don't be deterred. Undertake this journey one step at a time. Start with the basics: the EPS, the PE ratio, the dividend yield. Familiarize yourself with these metrics until they become second nature. Then gradually extend your knowledge base. Learn about the company's debt levels, its cash flow, its competitive standing. Study the industry, the economy. Bit by bit, you'll accumulate a comprehensive understanding of the company and its stock. Let's not forget, investing is not about mindlessly following trends or making quick short-term gains. It's about making informed decisions. It's about understanding the value of a company and its stock. And that's where analysis comes into play. Fundamental analysis is a powerful tool for picking potentially profitable stocks. It's not infallible, but it's an indispensable part of any investor's toolkit. So get out there, start analyzing, and let's unearth those hidden gems. So we've covered the history of the stock market, trading basics, technical and fundamental analysis. But what's next? With this question as our guide, we embarked on a riveting tour, delving into the intricate labyrinth of stocks and markets that define the world's financial outcomes. Our initial stop was the ancient background of the stock market, an area often underestimated, yet brimming with profound wisdom. We ventured into the deep annals of history, tracing the origins of the stock market back to the 17th century. This was a transformative period when the seeds of modern trading were sown, setting the foundation for the financial exchanges we witness in the bustling world of today. Gradually, over the teeming centuries, these exchanges morphed into an international behemoth, rhythmically resonating with the rise and fall of economic trends. The historical context acts as a potent demonstration of the resilience and dynamism of the stock market. It highlights the significance of comprehending the environment in which we trade today and the various forces that continuously shape it. Subsequently, we plunged into the fascinating mechanics of trading. We meticulously unraveled the concept of stock trading, peeling away the intricate layers that often bewilder newcomers. Trading, we discovered, is far more than merely exchanging stocks for money. It involves a labyrinth of complex procedures, necessitating a deep understanding of market operations. We dissected different types of orders, from the immediacy of market orders to the precision of limit orders, understanding their significant contribution to the art of successful trading. We learned that every trading decision is a calculated move on this grand chessboard of finance, guided by an intricate understanding of these operations. Transitioning from the bustling world of trading, we ventured into the realm of technical analysis. This discipline involves deciphering stock charts, which at first glance may seem like a chaotic assortment of lines and patterns. However, we learned that these charts are reflective of market sentiment. They offer crucial glimpses into market tendencies, empowering us to predict potential price movements. This knowledge equips us to make informed trading decisions, and when harnessed correctly, technical analysis can prove to be a formidable tool in our investment arsenal. Having soaked in the world of charts and patterns, we then journeyed into the domain of fundamental analysis. Here, we mastered the art of evaluating stocks based on a company's financial condition, its standing in the industry, and macroeconomic factors. We found that a stock's price isn't necessarily an indicator of its value. Understanding the distinction between a company's price and its intrinsic value is integral for identifying undervalued stocks, thereby offering opportunities for strategic long-term investment. While we journeyed through these vast expanses of knowledge, it's vital to remember that learning is an ongoing process. The stock market is a living, breathing entity, continually evolving and adapting to the ever-changing world. Techniques and strategies that were potent yesterday may be outdated today. In this regard, continuous learning is an essential aspect of successful trading. The most affluent investors are lifelong learners, refining their trading strategies to align with the ever-evolving market trends. Investing in the stock market isn't a magical formula for instantaneous wealth. It demands patience, discipline, strategic planning, and a profound understanding of the market's rhythm. As you embark on your investment journey, setting clear goals, creating a sturdy risk management plan, and building a diversified portfolio is critical. Remember, investing isn't about winning every trade. It's about steadily building wealth over time. It's a marathon, not a sprint, a test of endurance where patience, wisdom, and strategic planning often triumph over impulsive decisions. Feeling overwhelmed at the onset is perfectly normal. The world of trading, with its myriad of charts, numbers, and precise terminology, can seem intimidating. But don't be discouraged. Every accomplished investor was once a novice. Therefore, take that leap of faith. Begin learning, start investing, and embark on growing your wealth. The stock market is akin to an expansive ocean brimming with opportunities waiting to be tapped. So dive in, equipped with knowledge, patience, and a well-thought-out plan, and you'll be well on your way to a successful investor. After all, every successful investor was once a beginner. Therefore, ignite your journey today, and who knows where you'll be tomorrow. Before we wrap up this comprehensive guide to the stock market, let's take a moment to recap the critical points we've covered. We began our journey with an exciting look at the history of the stock market, tracing its evolution from the earliest recorded exchanges during the 17th century through the adaptability of the 19th century and into the digital revolution of today. It's captivating to see how far we've come, from the bustling trading floors filled with shouting brokers to the click of a mouse on digital platforms. It's a journey that reflects the innovation of human spirit and the relentless push of technological progress. Next, we plunged into the deep waters of trading, aiming to unravel its many layers and complexities. We demystified the world of bulls and bears, bid and ask prices, and most importantly, the critical role of different types of orders in trading. We learned about market orders, limit orders, stop orders, and more. These orders, when used wisely, can greatly enhance your trading efficiency and increase your chances of realizing favorable returns. Venturing further, we turned our attention to the world of technical analysis. This tool, used by traders globally, can help predict future price movements based on past trends. We learned how to decipher the cryptic language of charts and patterns, understanding what they whisper about the market's possible future movements. This skill is like a secret code, and once mastered, can significantly boost your investing prowess. We then transitioned into the territory of fundamental analysis, which is another essential tool in an investor's toolkit. Fundamental analysis helps you understand the financial health of a company, its competitive landscape, and its potential growth prospects. By learning to evaluate a company's intrinsic value and identifying potential long-term investment opportunities, you're empowered to make informed decisions about where to allocate your capital. The stock market, however, isn't a static entity. Like a living creature, it's dynamic and ever-evolving. Thus, the key to success lies in continual learning and adapting to these changes. Thankfully, there are countless resources available to help navigate these tumultuous financial waters. Websites like Investopedia, MarketWatch, and Yahoo Finance provide a wealth of information that caters to every investor, from the novice just starting out to the seasoned pro. You could also consider reading investment classics like The Intelligent Investor by Benjamin Graham, or A Random Walk Down Wall Street by Burton Malkiel. These books are treasures of wisdom, offering in-depth, timeless insights that can help further your understanding of the market. Yes, investing can seem daunting at the outset, but with knowledge, patience, crafted plan, you can learn to ride the waves of the stock market with confidence. Remember, you're not venturing into these waters alone. There's a community of investors out there, a wealth of resources at your fingertips, and there truly is no better time to start than now. The world of investing is like an expansive ocean of opportunities. So don't keep waiting for the right moment. The perfect moment is now, and time is indeed money in this world of opportunities. It's time to dive in and start your investment journey. Thank you for joining us on this journey, and we hope this guide serves as a stepping stone towards your successful investment journey. Remember, the road to wealth is a journey, so start investing, start learning, and start growing your wealth today. Welcome back, dear viewers. Our journey into the intricate world of stock trading continues. After shedding light on the fundamentals of the stock market, our next stop is an industry that has overwhelmingly dominated the airwaves in recent years: the technology stocks, fondly referred to as tech stocks. Tech stocks, in simple terms, represent in technology-focused companies that are typically earmarked by rapid growth and an ever-active, innovative spirit. These companies have emerged as the pillars of our rapidly evolving economy, pushing the boundaries of human imagination and significantly molding the way we live and interact. With the advent of cutting-edge technologies, our lives have been reshaped in a myriad of ways. Our day-to-day activities revolve around these technological marvels, from the ubiquitous smartphones that keep us connected to the world, the easily accessible search engines that answer our every query, the booming e-commerce platforms that bring the marketplace to our fingertips, to the cloud computing services that have revolutionized data storage and access. The technological landscape has fundamentally changed our way of life. And the masterminds behind this tech revolution, global giants like Apple, Google, and Amazon, to name a few, are taking the lead. Their audacious ambition, coupled with relentless innovation, makes tech stocks some of the most potent growth drivers in the market. However, investing in tech stocks is not as straightforward as it seems. Like every investment avenue, tech stocks have their unique risk-reward dynamics. On the brighter side, we have the tantalizing prospect of strong returns. Over the past decade, the tech sector has outperformed almost all other market sectors. Early investors in companies that started as modest startups and grew into global behemoths have reaped exponential returns on their investments. But the journey isn't always smooth. The tech sector is notorious for its volatility. The rapid pace of innovation often leads to fierce competition, making it tough for companies to hold on to their competitive edge. In addition, the high growth expectations from these companies often result in stock prices. This can lead to significant losses if the growth projections are not met. Nevertheless, the potential rewards offered by tech stocks can make them an invaluable addition to your investment portfolio. Armed with the right research and a well-structured investment approach, they can serve as a reliable vehicle for meaningful wealth generation. However, always remember, investing in the stock market is not a sprint but a marathon. It's about securing long-term growth and wealth accumulation. So, take the time to research, inform decisions, and, most importantly, be patient. And with that, we conclude our extensive exploration of tech stocks. We trust this has provided you with a deeper understanding of what tech stocks are, their significance, and how they could fit into your overall investment strategy. Remember, the world of investing is akin to an ocean of opportunities filled to the brim with exciting prospects. Don't hesitate to delve deep and unearth the treasures hidden within. Until we meet again, continue investing, continue learning, and continue on your journey to wealth accumulation. Stay tuned, as we're about to do a quick recap of the insights we've gleaned today. So, don't go anywhere. Welcome back to our exhilarating journey through the high seas teeming with potential and opportunities in the stock market. We have so far traversed the exciting promise of growth and wealth creation. But it's paramount to remember that these waters are not always calm. They can be treacherous at times. Today we're going to take a detour from the sunny shores of prosperity and navigate through the stormy weather of some of the major stock market crashes in history. Those turbulent periods that have shaken the financial world to its core and taught investors invaluable lessons about the inherent risks of the market. First, we'll set our compass and journey back in time to the Wall Street crash of 1929. This devastating event marked the ominous beginning of the Great Depression, a period of severe worldwide economic depression that lasted for a decade. The crash was the unfortunate consequence of rampant speculation throughout the 1920s, which had led to an unsustainable bubble in stock prices. When the bubble ultimately burst, the fallout was enormous. It wiped out millions of investors, causing them to lose their hard-earned money, and triggered the worst economic crisis the world had experienced in the 20th. It was a stark reminder of the devastation that can result from unchecked speculation and greed. Fast forward to Black Monday of 1987, a day that goes down in history as the largest one-day percentage decline in the Dow Jones Industrial Average. This crash was so sudden, so severe, that it caused a wave of panic to spread worldwide, plunging countries into economic turmoil. The root causes of Black Monday are complex and multifaceted, but key players were computer-driven trading strategies, overvaluation of stocks, and a negative shift in market psychology. From there, we journey to the turn of the millennium, the period of the infamous dot-com bubble burst in 2000. This was a time marked by an unprecedented rapid rise and fall in the valuations of the technology sector equity. The crash came when investors finally faced the sobering reality that many of these internet companies, or the so-called dot-coms, were not profitable and probably never would be. This reality check caused a major market correction, wiping out trillions of dollars in market capitalization. Lastly, we'll revisit the financial crisis of 2008, triggered by the subprime mortgage bubble. This global economic crisis led to significant financial losses, bankruptcies of major corporations, and a downturn in stock markets across the globe. It affected every strata of society, from large corporations to average homeowners, and its ramifications are still felt to this day. These historical crashes serve as stark reminders of the inherent risks entwined in stock market investing. To navigate these unpredictable waters, it's vital to have a well-balanced portfolio and a thought-out long-term investment strategy. Remember, the stock market is not just about riding the waves of prosperity, but also about weathering the storms and emerging stronger on the other side. As we wrap up this chapter of our journey, it's important to remember that understanding the past helps us navigate the future. We don't study history to predict the future, but to better prepare for it. Next, we'll wrap up with a quick recap of the lessons we've gleaned from these historical market crashes. So, stay tuned. Now that we've journeyed through the tumultuous seas of the stock market and weathered the storms of major crashes, it's time to explore a more advanced and potentially lucrative aspect of the financial market, options trading. This is not for the faint-hearted, but for those ready to delve deeper and expand their investment horizons. Options are financial derivatives, a type of contract that derives its value from the performance of an underlying entity, such as an asset, index, or interest rate. In simpler terms, options give the buyer the right, but not the obligation, to buy or sell an asset at a predetermined price within a specific time period. This opens a world of possibilities for strategic investment and risk management. Options come in two main flavors: call options and put options. A call option gives the holder the right to buy a stock at a certain price, known as the strike price, before a specified date. On the other hand, a put option gives the holder the right to sell a stock at the strike price by the expiration date. Understanding this difference is crucial to mastering the art of options trading. Like any aspect of the financial market, options trading comes with its own set of risks and rewards. The potential for high returns is enticing, but the risk of loss is equally real. In some cases, you could lose your entire initial investment, or even more. Therefore, it's imperative to fully understand the intricacies of options trading before you dive in. As we close this chapter, remember that options trading can be a powerful tool in your investment arsenal. But it's not a one-size-fits-all solution. It requires careful analysis, strategic planning, and a clear understanding of the risks involved. Always do your research and consider seeking advice from a qualified financial advisor before diving into the deep end of options trading. In our next chapter, we'll explore some real-life examples of options trading strategies to help you better understand how they work in practice. So fasten your seatbelts and prepare for another thrilling ride in the world of finance. Until then, happy investing. In the vast ocean of financial opportunities, there are some dangerous predators lurking beneath the surface. These are the scams that prey on unsuspecting investors, threatening to sink their financial ships. As we navigate through these treacherous waters, it's important to understand the common types of stock market scams and how to avoid them. Firstly, we have pump and dump schemes. This is where fraudsters artificially inflate the price of a stock they hold by spreading misleading positive news. Once the price is pumped up, they dump their shares, causing the price to plummet and leaving other investors in the lurch. Next up, we have insider trading. This is where individuals with non-public material information about a company use this privileged information to their advantage in the stock market. It's an illegal practice that undermines the fairness and integrity of the stock market. Then there are Ponzi schemes named after the notorious scammer Charles Ponzi sketch B2 Puan and B. In these schemes, fraudsters use funds from new investors to pay returns to earlier investors, creating the illusion of a profitable investment. However, once new investments dry up, the scheme collapses, leaving the investors with significant losses. While the stock market holds the potential for great reward, it's crucial to stay vigilant and protect yourself from these dangerous scams. Always do your research, verify information before investing, and never let greed cloud your judgment. Remember, if an investment sounds too good to be true, it probably is. In our next chapter, we'll delve deeper into the strategies for prudent and secure investing. Until then, stay safe, stay informed, and happy investing. In the ebb and flow of the financial seascape, there are periods of extraordinary growth and prosperity. These are known as stock market booms. During a stock market boom, share prices rise significantly, often driven by economic factors such as strong GDP growth, low unemployment, and technological advancements. Take, for example, the Roaring Twenties, a time of great economic growth and prosperity in the U.S. The stock market experienced a massive boom, driven by post-war optimism, technological advancements, and widespread speculation. Or consider the dot-com boom of the late 1990s. This was fueled by the rapid growth of the internet and technology companies. Stock prices soared as investors rushed to ride the wave of the new economy. Booms can bring a surge of wealth and opportunity. They can generate jobs, increase consumer spending, and create a sense of economic well-being. But they can also create economic bubbles. When share prices are inflated beyond their true value, the bubble can burst, leading to a market crash. For investors, booms can be an exciting time, but it's crucial to remember that what goes up must come down. As we ride the wave of a boom, it's important to keep in mind the fundamentals of investing. Don't get carried away by the hype. Do your research, invest wisely, and always have a plan for when the tide turns. Stay tuned for our next chapter where we'll explore the flip side of booms, stock market crashes. Until then, stay smart, stay safe, and happy investing. In the world of investing, there are some stocks that have stood the test of time and consistently delivered impressive returns. These are often referred to as the Magnificent Seven of the stock market. Just as the Magnificent Seven of the Wild West were known for their prowess and skill, these companies have proven their mettle in the financial frontier. The Magnificent Seven refers to 7 of the most influential and profitable companies in the world. These include Apple, the pioneer of personal computers and smartphones; Microsoft, the software giant that brought us Windows and Office; Amazon, the e-commerce behemoth that revolutionized online shopping; Google, the search engine leader that has branched out into numerous other tech ventures; Facebook, the social networking powerhouse that has redefined how we connect and communicate; Tesla, the electric car trailblazer pushing the boundaries of automotive technology; and Netflix, the streaming service that has changed the way we consume entertainment. Each of these companies has a unique business model and has made significant contributions to their respective industries. They have demonstrated resilience in the face of market downturns and have consistently grown their market value over the years. Their stocks have been some of the best performers in the market, delivering impressive returns to their shareholders. But remember, while investing in these Magnificent Seven can be a strategic move for diversification and long-term growth, it's not without risks. As with any investment, it's important to do your research and understand the risks involved. These companies, despite their success, are not immune to market volatility, competition, regulatory challenges, and other risks. So before you saddle up and ride with the Magnificent Seven, make sure you've done your homework. Understand the company's business model, financial health, growth prospects, and potential risks. And as always, don't put all your eggs in one basket. Diversify your portfolio to spread the risk and increase your chances of earning a good return on your investment. Stay tuned as we continue our journey through the stock market landscape. Until then, stay smart, stay safe, and happy investing.